They promised massive returns. They claimed it was legit, but in the end, thousands of Nigerians and Kenyans lost millions. The name? CBEX. The story? Another Ponzi scheme that left financial heartbreak in its wake. If you think it can't happen to you, think again. Welcome to Finance Hacks TV, where we break down money matters and help you build real wealth the smart way. Today, let's talk about how to spot and avoid Ponzi schemes, no matter how legit they may look. Let's start with the basics. What exactly is a Ponzi scheme? At first glance, it looks like any other investment opportunity. There's a promise of high returns, sometimes even guaranteed profits. But here's the trick. Instead of generating real profits through legitimate business activities, the scheme pays early investors using the money from new investors. The entire system depends on a constant flow of new money coming in. Once that flow stops, when there are no more new investors to scam, the whole thing collapses, leaving most people with nothing. Now, let's look at a real-world example. The CBEX case is a cautionary tale for anyone who thinks they're too savvy to be fooled. CBEX promised incredible daily or weekly returns. Its promoters claimed the company was involved in cutting-edge cryptocurrency trading, oil investments, and global finance. The website looked professional. Investors could log in, see their money growing on a sleek dashboard, and even receive small payouts at first. But when it was time to withdraw larger amounts, the site suddenly crashed. Support lines went silent. The money was gone. Thousands across Nigeria and Kenya lost everything they had invested, sometimes their life savings. How did this happen? How do so many smart people fall for these scams? And most importantly, how can you avoid becoming the next victim? Let's break down the classic red flags that signal a Ponzi scheme. Here are 7 warning signs you should never ignore. First, guaranteed high returns with little or no risk. In the real world, every legitimate investment carries some risk. The higher the potential return, the higher the risk you're taking. If someone promises to double your money in a month or pays you a fixed percentage every week, be skeptical. There's no such thing as a risk-free investment with extraordinary returns. Second, a secretive or complex business model. If the promoters can't clearly explain how the business actually makes money, or if the explanation is full of jargon and technical terms you don't understand, that's a huge warning sign. A real investment opportunity should be transparent and easy to understand. Third, no registration with financial authorities. Every legitimate investment company must be registered with relevant regulatory bodies. In Nigeria, that's the Securities and Exchange Commission. In Kenya, it's the Capital Markets Authority. Always check for licenses or certifications. If you can't find them, or if the company dodges your questions, walk away. Fourth, pressure to bring others in. If you're encouraged to recruit friends, family, or colleagues, and if you earn more from referrals than from the investment itself, you're not just investing. You're participating in a pyramid scheme, which is closely related to a Ponzi scheme. Fifth, difficulty withdrawing your funds. Early on, Ponzi schemes often let you withdraw small amounts to build trust. But as time goes on, you'll start hearing excuses, technical issues, maintenance, or new conditions for withdrawal. If you can't get your money out, that's a clear red alert. Sixth, luxurious lifestyle displays by promoters. Scammers often show off flashy cars, expensive houses, and lavish vacations, all paid for with investors' money. They want you to believe they're successful, so you'll trust them with your own cash. Seventh, unrealistic timelines. If someone promises to double your money in a week or offers daily payouts that sound too good to be true, you're not investing. You're gambling with your future. So, why do so many people still fall for Ponzi schemes, even when the warning signs are right in front of them? There are a few key reasons. First, greed. The desire for quick wealth can cloud anyone's judgment. When you see others making money, or at least claiming to, it's tempting to jump in without asking too many questions. Second, ignorance. Many people simply don't have the financial education they need to spot a scam. They may not understand how investments work or what a reasonable return looks like. Third, desperation. In tough economic times, when jobs are scarce and bills are piling up, risky promises can look like a lifeline. Scammers know this, and they target vulnerable people who are searching for hope. Fourth, trust. Ponzi schemes often spread through social networks. Friends, church members, co-workers, or even popular online influencers. When someone you trust vouches for an opportunity, it's easy to let your guard down. But here's the truth. Wealth is not built overnight. Real, lasting wealth comes from consistent saving and investing over time. It's about learning financial discipline, diversifying into legitimate opportunities, like stocks, mutual funds, real estate, or your own small business, and avoiding shortcuts and emotional decisions. So, how can you protect yourself? Before you invest, always do your homework. Ask hard questions. Who is running the company? Are they registered with regulators? How exactly does the business make money? Can you withdraw your funds at any time? If the answers are vague, evasive, or too good to be true, walk away. Think long-term. Don't let the promise of fast money rob you of your future. Remember, if it sounds too good to be true, it probably is. Don't be the next victim. Be financially wise. Let's dig even deeper into how Ponzi schemes operate, and what you can do to protect yourself and your loved ones. Ponzi schemes are named after Charles Ponzi, an Italian-born swindler who, in the 1920s, promised investors in the United States a 50% return in 45 days by supposedly investing in international postal reply coupons. In reality, he was simply taking money from new investors to pay off earlier ones. The scheme collapsed when there weren't enough new investors to cover withdrawals, and Ponzi was arrested. But the basic structure of his scam lives on today, and it's more sophisticated than ever. Modern Ponzi schemes use slick websites, fake testimonials, and even fake regulatory documents to build credibility. They may claim to use advanced trading algorithms, cryptocurrency mining, or exclusive investment clubs. The technology changes, but the underlying fraud remains the same. In the case of CBEX, the promoters used the current buzz around cryptocurrency and global finance to lure people in. They promised daily or weekly returns, showed fake profits on investor dashboards, and even paid out small amounts to early investors to build trust. But behind the scenes, there was no real trading, no legitimate business activity. It was all smoke and mirrors. As the scheme grew, the promoters encouraged investors to recruit others, offering bonuses for every new person who signed up. This created a sense of urgency and excitement, as people rushed to bring in friends and family before the opportunity closed. But as soon as withdrawals started to outpace new investments, the system collapsed. The website went offline, support vanished, and the promoters disappeared with the money. The impact of these scams is devastating. People lose not just their savings, but also their trust in financial systems and in each other. Families are torn apart, friendships are destroyed, and entire communities can be affected. It's not just about money. It's about hope, dignity, and the future. So, what practical steps can you take to avoid falling for a Ponzi scheme? First, educate yourself. Learn the basics of investing. Understand that real investments involve risk, and that higher returns always come with higher risk. If you don't understand how an investment works, don't put your money in it. Second, check credentials. Every legitimate investment company should be registered with the appropriate regulatory authorities. In Nigeria, check the Securities and Exchange Commission. In Kenya, check the Capital Markets Authority. You can usually verify licenses online. If you can't find any record of the company or if the documents look suspicious, stay away. Third, beware of pressure tactics. Scammers often use high-pressure sales techniques to get you to invest quickly, without thinking it through. They may say the opportunity is limited, or that you'll miss out if you don't act now. Don't let anyone rush you into a decision. Take your time, do your research, and consult with trusted advisors. Fourth, watch out for secrecy. If the promoters are reluctant to share details about the business, or if they use complicated jargon to confuse you, that's a red flag. Legitimate investments should be transparent and open to scrutiny. Fifth, test withdrawals. Before you invest a large amount, try withdrawing a small sum. If there are delays, excuses, or new conditions, that's a sign something is wrong. Sixth, trust your instincts. If something feels off, or if the opportunity seems too good to be true, listen to your gut. It's better to miss out on a potential gain than to lose everything in a scam. Seventh, diversify your investments. Don't put all your eggs in one basket. Spread your money across different asset classes, stocks, bonds, real estate, and so on. This reduces your risk and makes it harder for a single scam to wipe you out. Eighth, seek professional advice. If you're not sure about an investment, talk to a licensed financial advisor. They can help you evaluate the risks and make informed decisions. It's also important to talk to your friends and family about these risks. Many Ponzi schemes spread through social networks as people recruit those they trust. By sharing what you've learned, you can help protect others from falling victim. Let's look at some common excuses scammers use and how to respond. If they say, "We're not registered because we're a private club," ask why a legitimate investment would avoid regulation. If they say, "Our returns are guaranteed because we use a secret trading strategy," ask for independent verification and proof of real profits. If they say, "Everyone is making money, don't miss out," remember that early payouts are often made with new investors' money, not real profits. If they say, "You can only withdraw at certain times," or "There are new conditions for withdrawals," ask yourself why a legitimate investment would restrict your access to your own money. Remember, scammers are experts at manipulation. They know how to build trust, create excitement, and exploit your emotions. Don't let them. Instead, focus on building real wealth the right way. Set clear financial goals. Save regularly, even if it's a small amount. Invest in assets that have a track record of long-term growth. Reinvest your earnings and let compound interest work for you. Be patient and avoid the temptation of get-rich-quick schemes. Building wealth takes time, discipline, and smart decisions. There are no shortcuts, but the rewards are worth it. Financial security, peace of mind, and the freedom to live life on your own terms. Before you invest, always do your homework. Ask hard questions. Think long-term. Don't let the promise of fast money rob you of your future. If it sounds too good to be true, it probably is. Don't be the next victim. Be financially wise. If you found this video helpful, like, comment, and subscribe for more practical money tips. Share this message to protect someone you care about. This is Finance Hacks TV, building your wealth, one smart decision at a time.